Hey everyone, happy Tuesday. As I'm recording this, it looks like today is going to be a beautiful day, maybe a little bit chilly, but if you're working from home or even if you're at the office, make sure you take a break and get outside at some point. A little bit of vitamin D probably do you a little bit of good. While you're out there, you might want to think a little bit about some year-end tax planning strategies, because who doesn't want to do that? Really though, looking for opportunities to save you some money. And as we're closing out 2020, I plan to hit on a couple of these strategies the next few weeks. And spoiler alert, on a larger scale, the NC planning team is working on a more detailed webinar about some potential tax changes that might be coming our way in light of the election. But this week, I want to focus on another CARES Act related change that might benefit certain business owners, especially in a year where situations out of our control have really impacted cash flows. So way back in March, the CARES Act temporarily repealed Tax Code Section 461L, which acted as a limitation on the amount of business losses that a non-corporate taxpayer could use to offset their non-business income. Previously, under that rule, a single filer could only deduct a loss up to $250,000 adjusted for inflation, and a married filing jointly filer could deduct $500,000 also adjusted for inflation, and any additional loss would be carried forward. This year, though, the CARES Act says that the entirety of your business loss can carry over onto your personal tax return. So, for example, let's say a single taxpayer has $400,000 worth of income and $350,000 worth of a business loss related to some separate business income. That taxpayer now, if those are the only two numbers we're working with, would have $50,000 worth of taxable income instead of $150,000, which is what we would have had under the old rule, where we would have said $400,000 minus $250,000. With $100,000 of carryover or carry forward loss. Well, under the repeal, under the CARES Act, we would just have $50,000 worth of taxable income, because you can take that entire $350,000 worth of business loss as a loss on your personal income tax return. Now that's great, and that's not all. The CARES Act also made this repeal retroactive for tax years 2018 and 2019, and that means that if this rule applied to you in one of those 2 years, you can now file an amended return and seek a refund for taxes paid in those years. But as you might expect, there is always a catch. If you can amend your return, you should. And this is because the IRS has said that the temporary repeal is not elective. In other words, the IRS will automatically be adjusting any carry forward you were planning to take in future years. So if you don't file an amended return, assuming that you're going to get the carry forward from that loss in those previous years, you're wrong. So the clock is ticking on seeking any refunds here. Once the statute of limitations for amending returns expires, the tax benefit related to this change is lost. So if you're looking into some year-end tax planning strategies with your advisors, make sure you take a look back to see if you have any unused losses that may get swallowed up by this rule change. The time it's going to take you and your advisors to look back through that is probably well worth your effort. You probably know if you had some losses in those years, may not know how much, but it's probably worth combing through. So as always, guys, thanks for watching. We're going to see you next time with another year-end strategy to consider, but as always, feel free to reach out with questions. Happy to look into these things a little bit more. Thanks.